Inflation, it's here. What is the best hedge against it? That's the million-dollar question. I'll even dedicate this little post to one of my favorite clients who I'll call for this post Mr. Inflation. He's been calling for inflation since I've known him 10 years ago, and even a broken clock is right twice a day. But anyways, Mr. Inflation and the rest of you, let's talk about where we are and really what's the best hedge against inflation. That's sort of a growing question that's coming up. So first of all, inflation. We are in an inflationary period, which simply just means cost of goods are going up. Now, that's generally healthy. You want cost of goods to go up 2 to 3%. That's what the Federal Reserve targets. Today, we are 4 or 5 times that, so it's not where we want it. But what are the causes? So first of all, we have 3.6% unemployment, so very low unemployment, which means there's a lot of people out there. Wage inflation has gone up. People are paying more to these people. They're making more, and there's a lot of them out there that are spending money. Second of all, we're still not caught up from the COVID original 22 backlog or 2020 backlog. So that's putting pressure. On top of that, you have China shutting down for a zero COVID policy, which seems a little silly because I don't think that's attainable. And then finally, the war in Ukraine and Russia is driving commodity prices way up. So what is the best hedge historically? What works the best? Now, I may annoy you. This may not make you happy, but the best hedge against inflation, you guessed it, is stocks. I know your head's about to explode. You don't like me saying that, especially when the markets have had sort of a free fall the first quarter and a half here this year. But when you think about it, it makes sense. Public company, $300 million market cap or more. So these are big companies. They produce goods or services. And guess what happens? If those goods and services cost them more money, what do? They have to pay more money to get those costs and goods. Now, these public companies aren't in the business of not making money. So what happens? So I'm a manufacturer. I sell a widget, and it costs me 10% more to get all my goods to sell that widget downstream to a thriving economy, a fully employed economy. What happens? Well, my prices don't stay stagnant because I have a workforce. I'm not going to lose money as a public company. I'm going to pass those costs down the line. And so that drives revenue up. And what follows is, historically, stock prices go up. So stocks in and of themselves, by their biological makeup, are great historical hedges against inflation. Now, we're in a bit of a paradigm here, and things are all over the place, and there's some repricing going on and hyperinflation. There's a lot of factors that are sifting their way and working themselves through the markets. But the long-term effect, the best place you can be to combat inflation long-term is certainly the stock market and publicly traded companies. Now, one other thing to touch on, because a lot of times in these environments, people sing sort of the commodity song, and they really want to overweight or buy commodities as they think that's a great hedge. In our mind, it's a very inefficient asset class and has a lot more risk with a lot less return historically than stocks. So although it may have a place in some people's portfolios, in our mind, at mass market, it is not a great piece to hold. We feel you can get the outcome more predictably, better by owning stocks than commodities. So, bite the bullet. We may have further to go. It's anyone's guess. We'll see where things land here. But if you sit back and you look in hindsight in 2, 3, 4, 5 years from now, you'll find generally that stocks was your best way to fight inflation and still come out ahead. As always, I'm president of Diversified, Andrew Rosen. Stay healthy, stay wealthy, and stay happy. Thanks.